A new world order is coming and is going to change the way that you look at money and investing forever. At least that's according to BlackRock, who says that we're entering a new world order, which is why they're changing the way that they invest their money in 2023. If you don't know, BlackRock is one of the largest investment companies in the world because they have over $10 trillion in assets. By the way, the reason I'm doing this video sitting down is because I messed up my ankle when I was skiing recently, and so now I'm on crutches, so thanks for bearing with me. But every year, BlackRock puts out their own economic outlook report, and as I'm reading through their 2023 economic outlook report, it became very clear that they believe we are in for pain in the economy in 2023. But then as I read further, they then talked about what they call this new world order that we're about to enter. According to BlackRock's economic outlook for 2023, there are four main factors coming together in 2023 that is going to bring pain to the stock market and the real estate market, which are contributing to what they call the new world order. Now, to save you the time of having to read through and analyze BlackRock's economic outlook report, I'm going to break it down for you here. If you want to read the whole thing, I'll put the link for you down in the description. But the four factors that BlackRock is talking about are: number one, higher interest rates; number two, higher than expected inflation; number three, an aging workforce; and number four, the geopolitical factors at play. Now, if we start by talking about number one, which is the higher interest rates have been slowing down our economy. Now, BlackRock, in their economic outlook, specifically talked about how higher interest rates are already slowing down our housing market, and how they predict that higher interest rates in 2023 are going to continue to slow down the housing market, which will have a trickle-down effect on many different aspects of the economy. Now, it's pretty clear that higher interest rates have an effect on our economy, even though about 12 months ago, the Federal Reserve Bank, before they started hiking interest rates, said that their interest rate hikes will not cool down our economy or our housing market because, according to the Federal Reserve Bank, our economy and our housing market is so robust that even the higher interest rates couldn't cool down our housing market or our economy. Now, here we are less than 12 months after the Federal Reserve Bank started to raise interest rates, and we are seeing the higher interest rates cool down the housing market and the broader economy. Now, I've talked about this many times, so I'm not going to go too deep into this here, but higher interest rates make borrowing money more expensive. So now if you want to go out and buy something with debt, like a car or a business or a home or furniture or whatever it might be, it's going to cost you more money. Not just because the price of the thing is higher, but because the cost of borrowing the money is more expensive, which slows down spending. When you slow down spending, this slows down the economy, and if businesses are making less money because people can't spend, and the reason why people can't spend is because it's less affordable to spend, right? The cost of borrowing is higher, which makes things less affordable. Well, people spend less money, which means businesses make less money. If businesses make less money, well, that means they have to cut back, because maybe they don't make enough money to continue paying their salaries. Maybe they don't make enough money to continue servicing their debt. Not to mention the fact that most debts outside of your mortgage are not fixed rate debts, meaning most debts have some sort of variable interest rate, meaning either it adjusts with the higher interest rates or it readjusts every certain amount of months or years. And so what we're going to see happen in 2023 and 2024 is we're going to see more and more debts readjust at the higher interest rates. In 2020 and 2021, we saw the biggest boom in debt ever. This is from our national debt to our corporate debt to consumer household debt. More and more people and entities and our government borrowed more money than ever because debt was so cheap. Well, now that the interest rate on this debt is rising, well, all of these entities are going to see their debt payments rise, assuming they don't have a fixed rate debt, which most of this debt is not fixed rate debt. Our government debt is not fixed rate debt. It readjusts every certain amount of months or years. Most corporate debt is not fixed rate debt. It readjusts every few months or every few years. And same with household debt outside of your mortgage. A lot of household debt, like credit card debt, is not fixed rate debt, meaning as interest rates go up, it makes your cost, your expenses, higher. And if incomes are not keeping up because your company can't afford to give you a raise, or because companies have to lay people off, or because companies are not making enough revenue, or because the government is not making enough tax dollars, well, now incomes are falling while expenses are rising. That's the first issue that BlackRock is talking about. And we've covered what's happening with interest rates pretty extensively on Market Briefs, which is my free financial newsletter. It's an easy way for you to stay up to date on what's happening in the financial markets when it's happening. It's a super easy and witty and fun to read email. You can read it in less than 5 minutes every morning because my team's breaking down what's happening with things like our economy, the stock market, the housing market, crypto, and the global economy into the email. So if you haven't joined Market Briefs yet, it's completely free, and you can join Market Briefs for free down in the description below. The second factor that BlackRock talks about is high inflation. And more specifically, they believe that inflation is going to be around higher than what economists are projecting. Now, you'll see towards the end why these different factors are going to contribute to what they call the New World Order. But for this higher inflation, if you zoom into this chart that they call the wishful thinking chart, you'll see that the red line is where inflation actually is, and the white lines show where economists predicted inflation would go depending on the time. And by 2023, not only did economists expect inflation to have already fallen below 3%, but they expect inflation to fall like a crater from here on out. Essentially, what BlackRock is saying is, look, no one has been right about inflation up until now. In 2021, everyone said inflation was transitory. In 2022, everyone said that inflation would be gone by the end of 2022. And then in the end of 2022, they said inflation would essentially be gone by the end of 2023 or early 2024. Now, here we are in 2023. We still have very high inflation, and everyone's still saying the same thing, that inflation is going to magically fall down very quickly. And this is where BlackRock is saying, well, we don't believe that to be the case. And up until now, essentially, the high inflation hasn't been that much of a problem because, like what many banks have reported, people still have the ability to spend and afford the higher priced things. People have been able to pay higher prices for cars. People have been able to pay higher prices for homes. People have been able to pay higher prices for things, even though they're squeezing themselves in debt. Like we're seeing credit card debt rise, but people are still able to buy these things, which is what BlackRock is saying, well, this can only last so long. And what they're saying is that by the end of 2023, when this excess money and excess spending ability starts to go down, that's when we're going to really see the effects of higher inflation. The third major factor that BlackRock talked about was the aging workforce. This one's interesting because what they said was when the pandemic hit, we saw this whole wave of people stop working who have not come back. People retired or they just stopped working for whatever reason, and now they're not coming back to work, which means we have less people working. And because we have less people working, we can't be as efficient as an economy, and that's holding us back as a society and as an economy. Now, I'm sure you've seen this where you can go to the Chipotle at 11 a.m. or 12 p.m. or 1 p.m. and sometimes they have the sign saying we're understaffed and we cannot serve you. Even today in 2023, you have restaurants that are understaffed, you have many companies that are understaffed, and at the same time, you have many people that are looking for jobs. But we're seeing this kind of discrepancy where the jobs that people are looking for are not the jobs that are available. And so while we do have more job openings than people looking for jobs, the people that are looking for jobs are not happy with the job openings that are out there right now. So we're seeing this kind of discrepancy in the workforce, especially with the changing workforce, because nowadays many people want the flexibility to be able to work from home, while many employers are now saying, nope, we can't do that anymore. You got to come back to the office. We've been seeing this across different sectors where employers, CEOs are saying you got to come back into the office. So we're seeing a changing workforce and an aging workforce, which is making our economy less productive. The fourth factor that BlackRock highlighted, which brings together their whole idea of this new world order, is the geopolitical issues that we're seeing right now, particularly the Russia invasion in Ukraine. Because what they're saying is that when Russia invaded Ukraine, this was a big shock to the world, one, in terms of a potential war, but then second, in terms of our reliance on companies and countries that aren't our own. So many European countries were reliant on Russia and Russian energy. And now when the Russia invasion in Ukraine happened, now these European countries are no longer getting the energy that they expected, which is creating a huge energy crisis in Europe, and it's also pushing some of these European countries into a recession. Likewise, here in the United States, we've been heavily reliant on China. But then when the pandemic happened and China followed the zero COVID policy, which meant that they were completely shut down even when we were open here in the United States, well, that affected us here in the United States because we had so much manufacturing that was being done in China. And so now when we're reliant on another country, which has their own rules, which has their own economy, that can affect us. Now, for the last couple of decades, globalization has been great because it allowed so many countries to expand, to open more factories overseas, to build products cheaper, to hire labor cheaper. But now what BlackRock is saying is we're seeing the opposite happen, where more and more companies are saying we don't want to have this globalization and deal with the potential risks of globalization. So they're trying to bring things back, which is good for some things and it's also bad for some things. Like it's good for our own economy here if we do more manufacturing here because there's more jobs in America. There's more things being done here. It's less risk on geopolitical issues. The bad side is, well, now you're going to have to pay more money for things because if you're manufacturing in America versus China, it's going to cost more money. The cost to make socks in America is a lot more than the cost to make socks in China. And so this move towards less globalization and more self-reliance is what BlackRock is saying is kind of the icing on the cake to push this new world order, because now you have more and more countries that are acting independently, especially economically, that don't want to rely on other economies. So now that you understand the risks that they're highlighting, let's talk about what this means. Now I want to start by talking about what this means for BlackRock and what they're doing, and then let's talk about what this means for you. So for BlackRock, essentially what they said in their economic outlook report is that they're going to be much more defensive with their investments. They're going to be investing in more risk assets, and they're going to be putting more money into bonds, meaning lending money. Because up until, well, pretty recently, lending money has given very little returns because interest rates have been very low. I mean, think about it from the bank's perspective. If you are lending money and getting a 2.5% return, because that's what a 30-year mortgage is, it's not a very high return. Well, now lending rates have gone up, and so now you can get a much better return by lending money. And the way that you can lend money is by investing your money in bonds. And this isn't just lending money to the government. This is also lending money to corporations and other entities. There's corporate bonds out there. Anybody can invest in these types of bonds. And what BlackRock is saying is that they expect to invest more aggressively in these types of bonds because of the much better rates and returns that you can get on these bonds now. For you now as an investor, the most important thing is to be calm and to again have a financial strategy for you. Don't just start throwing your money around based off of what some random bank or investment institution says. Come up with a strategy, invest your money for the long term, and then ignore the noise. That's the most important thing. If you're following a dollar cost average strategy where you invest your money every week or every 2 weeks or every month, and that's it, well, then don't worry about it. All the noise doesn't matter. Just keep following your investment strategy and just keep putting your money into the market because, well, these dollar cost average strategies predict and expect that you're going to see market swings up and down. It's a long-term strategy for a reason. And if you're more of an active investor, you're looking for individual deals, whether it's in the stock market or real estate, or you're buying businesses or something else, well, then in that case, you got to be picky and be patient. Because if we do see more economic pain, that means that we could see more opportunities. And this doesn't mean you have to time the market, but just understanding the different economic factors out there and making sure that the deals that you are buying are good deals and being a patient investor instead of just throwing your money in. Right? The best financial decisions are not made out of panic or fear or excitement or greed. It's decisions that are made out of financial decisions that are made out of logical thinking where you're calm and you understand what's going on. And then once you make an investment decision, you don't get hyped up by the noise, because the reality is this next 12 months, 2023, we'll just talk about this now because it's not ending in 2023. We're going to see more craziness in 2024 as we see more and more debt readjust in 2024. That's going to be a big issue in 2024, but we'll talk about that closer too. But in 2023, we're going to see a lot of things happen. We're going to see things happen with things like student loans. It looks like we might see some student loans start to come back. That's an expense for a lot of people who haven't had to make their student loan payments for a long time now. That could hurt the people's ability to spend. In addition, what many people are talking about is the pandemic era excess savings are going to go away by third quarter of 2023. That means that's when we'll start to see the real effects of inflation. People will really start to feel the pain of inflation around then. Not to mention the fact that the higher interest rates, even if they don't go much higher, but even if interest rates stay the same, which the Fed says that they're going to raise interest rates even more, but even if interest rates stay the same, we're going to see the absorption effect of the higher interest rates. That means we're going to start to see the actual effect of the higher interest rates in the coming year. Plus, we're also probably going to see even higher interest rates this year. So these factors take time to kind of price into the market, and just being a smart investor, understanding what's happening, that way you don't jump into the market or jump out of the market, being a patient investor, knowing your strategy and investing in your financial education right now. If you have any sort of this type of high interest credit card debt, you gotta pay it off as soon as possible. Don't worry about investing your money in the stock market. Don't worry about putting your money somewhere else. You need to pay this debt down as fast as humanly possible. The average stock market return is 7 to 10% a year. Why are you trying to